This is going to be a panel on sort of accounting fraud detection and fraud detection ideas in general, but more specific to accounting fraud. To my immediate left is Scott Bauguess, who I introduced in the morning, so I think I'll dispense with that introduction and move to Scott's left. This is Jeb Linton. Jeb is from IBM, and he is the Chief Security and Risk Assurance Architect for the IBM Watson Group, and he's the leader of the IBM Watson Cognitive Security Initiative. He's an IBM Senior Technical Staff member, and I was hoping you could explain maybe a little more. You're also listed as a master inventor, and I wondered how you got the designation master inventor, and whether that's an official title or not at IBM. But basically, he's been at IBM since 2008, and he's worked on a lot of different initiatives, cloud computing, storage, and analytic projects while he's there. Prior to IBM, he worked in the intelligence, defense, and service provider industries, and his major areas of work included high security, high availability systems, and network architecture. Holds a BS.EE from Virginia Tech. Jeb, thanks for agreeing to be on the panel with us today.
Thank you.
To Jeb's left is someone who also needs no introduction. It's Patricia Dechow. Patty is I always love the titles of the chairs that the various professors have. Patty is the Donald H. and Ruth F. Seiler Professor in Accounting at Haas at Berkeley. As you know, her research interests include the nature and purpose of accounting accruals, evaluating the quality and reliability of earnings, and the informativeness of earnings to capital markets, among other things. She's obviously widely published in all the top journals. She served on many editorial boards, currently an editor of the Review of Accounting Studies, and has been the editor of the Accounting Review. And it's just a brief aside, I've told Patty this before, but much of the initiative at the SEC with respect to the accounting quality model was really driven by Patty's research in this area. And I took a lot of inspiration from her papers and sort of building that out, and so give you that sort of academic or nod to your contributions in that area. To Patty's left is Vince Walden. Vince is Ernst & Young, and he is a partner there that specializes in forensic technology, anti-fraud, and forensic data analytics. Vince basically leads the data analytic initiatives at EY, and he's part of the global leadership team designed to look at skilled forensic technology and data mining. He's recently moved to the Southeast, so we consider him another Southerner now. Nice to be down. And basically, BS from USC. He's a CPA and a certified fraud examiner. He's also had a number of publications in sort of practitioner journals focusing on fraud and auditing issues. So Vince, welcome as well. Glad to have you here. And I thought the best way to really start maybe this afternoon's panel off would be to give Patty an opportunity to talk briefly about, as long as you want, but sort of briefly, about sort of an overview of the accounting literature that really discusses fraud prediction.
Thank you, Craig. And I made some slides here, if I can work out how to put them on. I don't know how do you get them back on? Maybe that's
Is this a
Under
PDF?
this.
Control-L. Is it a PDF?
no, it's just a PowerPoint.
Then I'm out of my...
They were up there before.
Is the control not working? The remote.
What are you supposed to do?
The remote. Try to,
I have
is
no
the,
idea.
Is the remote working? Yeah. The right and left.
Boy.
Oops. Oh, that's a little worse.
Yeah. Thank you. I don't use PowerPoint, so I'm not very helpful.
Yeah, I don't know how to. I don't use a one of these kind of computers. Sorry, everybody. Where's?
So maybe just click on the top. You see, you can see the mouse.
Well, no, I can't use the computer.
And
be totally useless here, but it's not a set of eyes.
I don't know how to,
That seems
I don't know how to get out of it. Should I just escape?
Yeah, I think just,
How about control?
you have control over it.
Well, I don't think it needs to be deleted, it's just, I
Is
mean,
there
it
a
just needs
lock
someone
on
who
the
knows how to
remote
use
control?
this. I mean, it's not locked, it's just, I don't know.
There's a different-
Anyone who knows how to use a, where did,
Wherever's going.
There's actually a different presentation that's on online.
I don't know.
Also, this isn't even,
No, this is mine, this is mine.
but
I
it's-
just
but
can't,
it's,
I can't work out how to,
yeah.
well, it's just, it's gone into the default one. Where is it?
That's probably true. This is up there.
Yeah, I just can't.
There's usually a function,
We have the IBM guy.
usually you can have something like function.
Greg, you just want to change the order of.
Have you tried that?
That's a good idea.
I don't know how to get it back into PowerPoint though. I mean, it's hard to use her computer.
All right. So I have a suggestion, since while we try to figure out the technical issues, Vince,
Well, there you go.
why don't you start us off? And we'll give Patty a chance to come in at the end and talk about an overview. Wait a
I
minute.
can just,
Greg, actually, if
Oh,
it
look.
comes up now, it's good, because I wanted to put my laptop up there and show some things. But,
there we go.
All right,
Okay,
looks like
so now
we-
we just have to get it
all
into,
The IBM guy's figuring it out.
Wrong mode.
we're safe as kids here.
maybe it's that little one there.
So we just learned what a master inventor can do.
Thank you.
Cross your fingers. Oh, wrong one.
Or maybe it press that. Maybe that's what's going. No. I don't know.
I'm not sure.
Go.
Yep, I'm not sure.
We're so close.
How about we do projector only? We got that option.
There it goes.
Okay.
But you can just have to see all my slides. Well, I don't know how to. Oh yeah, do you know how to get it into the?
Oh, there you go.
I don't know. What happened?
It's showing up on the screen.
Oh, there we go. Thank you. All right. You can see how successful my classroom experience normally is. So yes, I was asked to talk a little bit about just models in accounting, or in research that are looking at detecting fraud. And this is a very big area of research. And seeing as I've only got 10 minutes, I apologise in advance if I don't talk about your model that you've got, because there is. We all would like to be able to detect, some of these big frauds that have happened in the literature, and so a lot of research has kind of had a look at that. And from an academic perspective, I guess, we differ from regulators in the sense that, and this comes from a paper I had with Doug a long time ago, you've kind of got within GAAP accounting, and, you have conservative accounting, and then, we have this idea of neutral accounting, that the management are just trying to apply the rules as they believe should be. And then we have sort of this aggressive accounting, where the management might be taking actions to push a little bit. And then we have accounting that clearly violates GAAP. And I think from an academic perspective, we're pretty interested in just understanding the motives for aggressive accounting, and, what causes it, and what are the consequences of it, and how do you, does governance help, and all these kind of issues. So we have this sort of broader perspective, and we're less concerned about whether, the firms crossed the line and committed fraud in some sense, because we can't go in and investigate that anyway. So we're more kind of neutral on that aspect of it, and just saying, well, does this accounting look very aggressive, and what consequences will it have? So from a financial statement analysis perspective, we're always like, well, we're not going to try and judge these management, but given this kind of accounting, do we think it's going to have consequences in the future? Do you think that investors are going to realise what's going on, and so forth? So I think that kind of differs, our perspective differs a little bit from what the regulators might perspective, because they're really concerned about that bright line, that line between aggressive accounting and fraud, because they need to go after the fraud cases, right? And it's even like with the auditor too, they're going to be more concerned about, okay, where's that line, and which side are they on? So I think when we look at accounting research, that slightly different perspective means that when you're analysing the research, often the researchers haven't done their study in a way to directly address how good that model is for detecting fraud. And this is just from the accounting and enforcement releases. The SEC releases these documents about what firms they've gone after, and then they also disclose which years the firm has manipulated the earnings, and we collect them at Berkeley. And so what I wanted to just show you is the proportion of firms that are committing fraud, or at least have been identified as having misstated their financial statements each year. And what you can see from this graph over time is that it's a pretty small percentage. So it's like 1.5%, 2%. There's quite a few around the year 2000, and that's I think got to do with the stock option backdating scandal. There was a lot of focus on that, and that was a clear case where it was like the drug testing for athletes, where the SEC could go back in time and identify where firms were doing something wrong. So anyway, it's a pretty small percentage that are being identified, and I'm just comparing that here to bankruptcy or delisting, firms that delist, and you can see that's around 3% a year, trends in it. And so the fraud detection models have similar problems to the bankruptcy prediction models in the sense that you've got a very small proportion of firms that are doing it and pretty bad outcome. So it'd be nice to be able to predict it beforehand. And just looking now at models to detect manipulation. A couple of years ago, I did a sort of survey of some of these, and so this comes from there. Just like, well, what models do we have out there in the accounting literature? And originally, I guess quite a while ago, Richard and I and Amy Sweeney, we looked at this sample and focused on corporate governance and found that sort of like having an audit committee was important for predicting fraud back in the days when audit committees were voluntary. Now they're not so. Then we have another paper by Vida also looked at these kind of characteristics. And then Dan Benish developed an M score. And you can't really see too much which ones are bolded and not, but you'll see that there's a general, when we're looking at financial statements, you'll see that sales growth comes up there, and generally accruals are pretty important, right? I think that's one thing that we will become aware, that when management have more flexibility over what they're writing, what kind of entries are being made, then that gives them more flexibility to commit fraud. And then the other issue that people have looked at is whether CEO pay sensitivity affects the likelihood of fraud. And this seems like it would be obvious that if a management's more sensitive, if their pay was more sensitive, they'd be more likely to commit it. But the results in that area of literature are much more controversial than you might think. So there's people saying, no, it doesn't affect it. It's just the firm characteristics that you're picking up, not the management incentives. And others say yes. So, it's one of those open questions. But from an enforcement point of view, you might end up wanting to see whether those incentives, being able to justify going after a company because the management was getting paid a lot for the earnings or the fraud. In 2011, Richard I and Wei Gee and Chad Larson did a paper on a model trying to predict fraud. That's commonly called the F score. And in there, again, we sort of found that accruals were important and other characteristics, such as inventory and accounts receivable, which are like the key accounts that management seem to be able to manipulate, or that have a direct effect on the income number. So sales goes directly into the income as a positive number, and so there's a strong incentive there to manipulate. And after that, a lot of papers then use the F-score and then see whether their variable is incrementally informative. So I've got a paper by Feng et al. That's looking at how involved is the chief financial officer in this? Because they're the ones who have to write up the documents. And so do they do it when they've got stronger incentives? And their results were more just that they seem to be influenced a lot by the CEO and what he was up to, or she, I guess, mainly he. And then this Price et al. Paper, they look at commercial models and compare the academic models to the commercial models, and they argue that the commercial models are better, but then the commercial models are using the academic models, so it's kind of how to distinguish. So I'm not sure about that one. And then this Hebra paper I've got up there is looking at whether if the unexplained portion of audit fees, so if auditors are charging more than can be explained by the firm characteristics, does that incrementally explain a firm that's likely to have accounting problems or misstate? So they're kind of like some of the papers that have looked at this area, and the general overview you see is like people have looked at corporate governance and found that that some of the characteristics seem important, and then that financial ratios can help in isolating or predicting fraud. But one of the things that I just want to talk briefly about is just this classification issue that was talked about this morning. So this is just from our paper looking at the F-score, and what we do there is we have a cut-off level. We say, okay, this firm's likely to be, more likely to be a fraud firm. And then based on that cut-off, you can then classify firms into misstate category or not misstating category. So we've got our fraud firms, which misstate, and there's 494 of them, and then we've got the other firms, which is all the firm years in the population, which you can see there's 132,000 of them. So how well can our model separate those two is a pretty important question from a regulatory point of view too. And so one way, correct classification, when you hear people talk about that, is just, well, how many firms are correctly classified? So we'd like, really, if your model was 100% accurate, then all the fraud firms would be over there, or 494 would be in the misstate category, and all the other population firms would be in the not misstate. And you could argue, well, maybe some of those population firms are manipulating, but just didn't get caught because the SEC has certain criteria that they might use when selecting firms to go after. And then we've got sensitivity, which is to do with, well, how accurate is our model at predicting or identifying fraud firms, given we know that they're around. So the model was picking up about 68% of firms, of the fraud firms it could identify using this criteria. And so that tells you like how well your model's doing. 68% doesn't sound that great, but a lot of times in the bankruptcy literature, they kind of, depending on what cut-off level you choose, you can make it better or worse. And then we've got the type 1 errors, which is percent of non-fraud firms that are classified as fraud firms. So this is the innocent man goes to jail problem. So it's like, well, this is a problem that the SEC probably face a lot, that if you've got a model and you've got a lot of these innocent firms getting picked up as suspect firms, you have to put a lot of resources into that and checking which ones are good versus bad, and so that's quite costly. And same with audit firms, trying to, should we take this client on, and they look bad, but actually they're not. That's revenue you're not going to find. And then we have the type 2 errors, which is firms that basically get away, or the thief that got away, so that you don't pick them up, but they are actually a bad company. And that's very costly for the SEC too, because when something blows up, like Madoff or something, they look very bad. And also it's bad for investors. And audit firms have to worry about getting sued. So these are very high cost errors. So that's kind of just a breakdown. And I think that a lot of times in the academic literature, we don't really do that kind of analysis too much on our variables. We often have a variable that we're interested in, and we go and see if it's significant, but we don't try and check whether it's actually helping the model, helping us better identify frauds. We're more concerned with, well, does my economic variable that I think causes management to behave in a certain way, is it significant? So there's a slightly different perspective here. Here's another paper that's by Amarin, Bozanic and Ruin that looks at Bamford's law, which is a more computer-intensive type approach rather than looking just at the financial statements, where they look at the digits, the first digit of the numbers in the financial statements. And with this law, there's supposed to be more ones in the populations than nines for the first digit, so sure. So about 30% should be ones and nines are much lower. And then they point out in their paper about how with Bernie Madoff's funds of funds, he had a lot more ones than you'd expect by chance. So it's another kind of technique that people are using out there to try and find fraudulent companies. And I guess here is an example. They put their variable in the regression with other fraud variables and it comes up significant. So you say, oh yes, that's important. But what we don't really know is, well, how much extra do you necessarily get from doing that kind of analysis? And then there's sort of machine learning type models. And this paper by Cecchini et al., they basically get all the financial statement variables you can find out there and put them into a machine-readable machine and then let it work its way through and learn and try and come out with a better model. So it's very data intensive, which I guess Scott was talking about a bit this morning about how that doesn't necessarily always lead to intuitive results. And they show that their model's better at classifying fraud firms than the other models out there. And they actually replicate quite a few papers, including Benish and Dechow, and they find that they get similar results. So that's good from a replication point of view, that our results were replicable. But then they show that their machine learning technique is an improvement over the other types of approaches. So there's a lot of work moving that direction of looking at different ways of trying to detect fraud. And another area of research is this looking at non-financial measures. So this paper says, well, you can look at revenue growth, but how does it compare to the number of square feet that, the growth in square feet that the company has or the growth in retail outlets? They should sort of match with each other. And they look at this as another proxy for fraud and, again, find some results, significant results, using a matched sample approach. So it seems like non-financial measures might be important, but you're not necessarily always sure how that's going to fold in. And then there's people have looked at other sources of information, such as deceptive words and conference calls, vocal cords, and how whether your vocal tones change if you're lying, and also just off-the-job behaviour. So, if you're buying a lot of luxury goods and so forth, are you more likely to commit fraud? And so looking at other information beyond the financial statements to get an assessment of fraud. And then there's research, I guess I was doing a plug here for something we're doing, but just like looking at whether just this managing market expectations kind of concern, are they more likely to commit fraud if they're really concerned about what the market thinks of them, and do they consistently beat earnings forecasts? And right now the quite a big issue is just this pro forma earnings, and do firms that have pro forma earnings tend to be more likely to manipulate. So as far as the stock market's concerned, it seems like the stock market doesn't anticipate fraud. These firms that tend to commit fraud tend to be doing quite well in terms of their stock price performance. So this is a graph just showing their stock price before fraud and then after. You can see that after the fraud, the red line being the manipulation, after they finish manipulating they have significant declines in stock returns. So the key thing here is that when firms announce fraudulent reporting, as you know, it's a very bad news signal. The only one that's really worse is when they announce bankruptcy, right? So, which might happen a few years later for fraud firms, but is out there. So just to kind of give you a summary with these models, there's a lot of work out there on fraud. Financial ratios seem to help, so looking at the financial statements, these ratios seem pretty key. It seems like with computer-intensive functions might also help improve the coefficients that we get from these models. Non-financial measures seem to be useful, but they've been collected only on small samples, so you're not really sure how it builds up. Firms' relationship with the stock market seems important, but the stock market doesn't seem to anticipate frauds particularly well, so that has to be kind of going in there as well. Management characteristics, are they risk takers? What about their egos, crime, founders, their power, all seems to play a role. And the governance characteristics, management incentives. So a lot of variables have been looked at. How they all pull together and how important each one is individually is more difficult to say. Because of our academic focus more on just understanding the incentives and the causes and consequences, rather than being specifically focused on trying to get a model that best detects fraud and which components go into it. Because as Scott said earlier, that if the SEC found out that butterflies in China predicted fraud really well, they'd just go with that without having to necessarily do it. So it is a different... I thought so, maybe. That's my interpretation. So they have a slightly different perspective. So maybe as academics we could try and think about that when we're also producing our research, rather than just saying, oh, well, my variable came up significant, yes, that's good, end of paper. We could think about whether it actually has what's the bigger implication here in this kind of framework. So thank you.
Thank you, Patty.
Sorry about that.
So I thought what we would do is now we will transition from academics to the practice. And Vince?
Yes, I'm already ahead. I'm already over here.
Go for it.
I have that. I was, first off, it's an honor to be presenting to you guys in this audience and representing the academic community, the impact that you as a group have on students coming out of universities that we ultimately hire. So I wanted to take this opportunity to show you a little bit about what we're doing in the field of forensic accounting, particularly around forensic data analytics, and perhaps even make a plea to you to consider some of these new analytics and techniques around big data as we crank out energetic young students so that we can immediately put them to use. There is a sea change going on in how we are fighting fraud within our clients. And again, my clients, I'm not taking a regulatory perspective. I'm taking a CFO, internal audit, my buyers, CFO, internal audit, in an investigation context, it's the general counsel. And it's heads of investigation. So I wanted to share with you some concepts and some practical examples on data analytics. If you guys aren't familiar with dashboards and how we're using them instead of Microsoft Excel, you're going to see it. And again, your students, I want to see it from them. So this is my cry out to you guys to think about how we are integrating big data into the accounting profession to really accelerate the prevention and detection of fraud, but overall deliver higher quality. Because we're using these in the audits, we're using these in our investigations, and again, I'm excited to show these to you and get your input. So first and foremost, let's start with the definition. As we think about big data, and you all have heard that name, and again, it's been used for many years now, but make sure you remember the 3 V's. It's not just large volumes of sets. It's the variety. We've talked about text analytics. Scott, you're going to talk about that too. And Jeb with Watson, it's actually good that I go second because I'm going to tee you guys up really well here. Text mining is a game changer, and that's the variety of data. It's not just the ERP and financial systems data anymore. We are injecting it with third-party databases, with social media, with email, to paint a full picture of what fraud risk looks like. And then the velocity, the speed at which trade and information data changes and comes in, really impacts, our accounting principle of timeliness, really impacts how we address that in our analysis. So high volumes, yes, we know that. But variety, think outside the ERP systems. It's good, but it's not everything. And velocity with the speed that changes, key factors. So as we think about what those variables are, and again, I'm going to watch my time very close, Craig, so I promise I won't go over. These are the things that we're doing that make a difference when it comes to forensic data analytics. Multiple data sources, it's that variety, both structured and unstructured data. The visualizations, and I'm going to show you some. Text analytics. Corrupt intent lives in the text. Doesn't live in the numbers. You might catch it a little bit with the ratio analysis, but good luck. Corrupt intent lives in the text. I have found more corruption and improper payments from what people put in the free text field descriptions of an accounts payable subledger than any other source. Hands down, it's awesome. So I want to talk to you about, I'll show you some examples of that. Payments and transaction risk scoring. How do we eliminate false positives? How do we objectively and repeatably show that these are the top riskiest employees or riskiest transactions or riskiest vendors? By doing it objectively and repeatably in a risk ranking model, those people that are triggering multiple criteria really helps reduce false positives and gets you to answers faster. And I'll show you some examples of that. Predictive modeling. Find me more like this. When you're tagging transactions, and again, we talk about machine learning. When you're tagging transactions, training the model to then go find me more like this, it's a game changer. We've used it on anti-corruption investigations. We use it on financial misstatements. Building that model is an important concept. But you can't have a predictive model if you're not tagging what bad looks like. Most of us look in Excel and try to tag it or color it or put an X by a transaction that's suspicious. If that's not going and feeding into the system's not able to learn. So you got to have a case management platform to track that type of thing. And then the deployment models. We're seeing companies take their data to the cloud. There's software as a service models for these analytics. There's mobile kits. When you think about data privacy and EU and now China state secret laws, you can't take data out of China if you want to live. And that was the strong message that we got when we do our investigations in China. You got to be on site, and that's where you need the mobile kits to go on site. And then also deploying in-house. So with these concepts, here are the types of categories that we're using these types of analytics on. And if you think about the full spectrum of what's available in your accounting data, from meals and entertainment, travel and entertainment, you get the big hits on the sales and distributor margin analysis, a lot of revenue recognition issues, that's still alive and well. But most importantly, it's around the accounts payable and receivables. Who's getting paid? We talked a lot so far in this conference around financial misstatement, but more so, corruption is a key risk area in terms of where, and again, that's still fraud, but corruption and even asset misappropriation, particularly digital assets nowadays, are top of mind with companies. So if we think about the traditional accounting in yellow, but these emerging type of areas to look at, from social media to advanced email monitoring to mobile devices, I'll just give one example on this social media. Very cool. It's a simple test, and I encourage you researchers to think about this. On almost every time, Scott, could you close your ears? Just kidding. Go and look at the social media. If you want to look for leakage of material non-public information, go to Twitter, and the date of the announcement of a company, find out that company announced that the acquisition was on this date, right? Go to Twitter the week before and see if there are mentions in social media of that company acquiring that company or spinning off or earnings or not making target, etc. It's a great thing to look at. And I encourage companies to take a look at that. And it's a great compliance control to make sure that things aren't getting leaked. Because sure enough, oftentimes either the news media is leaking at it or what have you. It's out there. So interesting observation that social media can use as a data source for data leakage and insider trading. As you bring it all together, I'll give 3 more minutes. This is what we look like from detection, responding, and discovering and investigating. These are just the categories of types of tools that we're using and pulling together. No one tool does it all. Excel doesn't do it all, for example. But the visualization and the dashboarding and the risk on the upper left, the statistical model and the text mining, which is the find me more like this, and letting the data describe itself through anomaly detection, k-means clustering, for example. Great way to identify topics. Once you find it, that's when you use the pattern and link analysis to say, here's the entity, who else is in the loop, or how is this, what's the relationship of the fraud scheme and how they're connected. That's where the pattern and link analysis comes in. And when you find it, putting it into some case management system such that you can then tag it and follow it up allows it all to come together so that the system can learn. And as we use these types of dashboards, the back end of this stuff is just a database, right? It could all have been loaded in SQL for that matter. In larger sets, in smaller sets, it could be in Excel. But when you visualize it in dashboards that meet that specific need, whether it's payment, whether it's inventory or salaries or travel, entertainment, payables, etc., visualizing it makes spotting fraud that way versus looking at it in rows and columns in a spreadsheet is night and day in terms of its effectiveness. What do I mean by that? Imagine a Microsoft Excel dump of accounts payable transactions. This is put in Tableau, and I've done text mining on the free text descriptions. And lo and behold, and I've seen this before, when I see a word called friend fee describing $4 million of payments, what is that? That's probably a bribe. But no one's going to book it as bribe expense. I've seen friend in camp, I've seen friend fee, I've seen KB. Well, what did KB stand for? Stood for kickback. Accountants, the beauty about accountants, which is I'm one of them, I love us, we're great. We love to book things and we love to track things. So if we're forced to commit fraud in a country that we're under pressure to commit, we're going to track it somehow. And we're not going to let it go because we want to be able to recall it if need be. So we're going to come up with a code word to try to track it. Free text descriptions can be very telling. And looking at it from a who, what, where perspective makes all the difference. And then that topic of risk scoring. Imagine that these are third-party vendors, and I've set up multiple tests from maybe payment on the weekend to a sensitive keyword to a statistically anomalous, and every time that hits one of my thresholds, it gets a point, and I can control the weight on the point on the right. But then based on those risk scores, find me the vendors that are triggering on the majority of my tests and focus my audit and my resources on those areas. That's allowing me, rather than statistical sampling, which good luck trying to find fraud with sampling. It's like a needle in a haystack. But if I can risk score 100% of the data and focus on the ones triggering multiple criteria, I can be much more effective. One last research idea, fraud triangle analytics. We did this about 5 years ago as a joint research project with the ACFE. It's interesting to note that dear old Cressy's theory on the fraud triangle, pressure, opportunity, and rationalization can be seen in people's email communications. We've done it multiple times. When I see spikes in people's pressure, opportunity, and rationalization type words, which we have these libraries in about 18 different languages of what one means by pressure, what means pressure, like under the gun or meet the deadline. Those words mean different things in different countries. But opportunity and rationalization, I can objectively plot email communications and score people based on their propensity towards pressure, opportunity, and rationalization, and then look for spikes when they line up. Like that gentleman in 2009, Russell Draper, who spikes in July 2009, I want to go look at those communications. And that's where I could see, perhaps in this case, it was a rogue trader. So bringing it all together, when I think about how analytics is deployed at companies, you've got multiple data sources, not just one. Going through your library of counter-fraud tests, doing advanced text mining and search, visualizing and risk scoring, but then getting into some more investigative tools like statistical and predictive analysis. We talk about Watson. We're very excited about what we're seeing in cognitive. And then that pattern and link in case management, combining both the investigative mindset with the traditional audit and monitoring, brings it all together in an analytics platform. And that's what an effective analytics program and framework would look like within a corporation. So with that, that is basically my slides. I wanted to show one last thing. This is just kind of a fun dashboard around emotive tone. So when we think about emotive tone and communications, hopefully that should come up. If not, I'll just stop. I think I'm having the same problem. I better quit while I'm ahead because we're just about out of time. But I wanted to show there's emotive tone, and I'll leave you with this thought. If it pops up, great. But we maintain a library of thousands of anti-fraud tests. We've essentially taken the fraud tree by corruption, asset misappropriation, and financial misstatement, and developed hundreds of fraud tests from that fraud tree. In fact, we like I said, we collaborated with ACFE, and actually we're building ACFE's website on the back end to help make the community aware of some of the tests that can be done to stimulate more analytics thinking or more analytic thinking around specific fraud risks. So look for that on the ACFE's website in about 2 to 3 months. It's also going to be in line with the new COSO guidance that's coming out at the end of this month. If you're all familiar with COSO, principle number 8 to the 2013 framework, which Dan Amorim, you're a consultant or an advisor on it, and I think Craig, you are too, and thank you guys. We're really excited about coming out with this guidance. I was one of the co-authors on that document. Particularly, they asked me to contribute to the fraud, the data analytics components. And this new guidance, which is the guidance for principle number 8, fraud risk assessment, is going to have a lot of new information, exactly like what I just showed you, focusing on the emphasis of data analytics. So it's really exciting for the accounting profession to adopt this. So thank you very much for the opportunity to present you guys, and look forward to our discussion.
Great, thanks, Vince. So, our next speaker is Jeb Linton. Jeb, I think most of us have probably seen commercials on television, sort of talking about and extolling IBM Watson. Hoping you can give us a little bit of maybe a better understanding of what Watson is about and how it's being used in the area of fraud detection.
Happy to. Just quick show of hands. Who knows what this Watson thing is? How many of you, for example, saw the Jeopardy program years ago? Okay, so a few. I like to tell the story of Watson starting with 4 guys walk into a bar, because it sounds like a joke, but that's actually how it got started. See, they had been coming off of a program, or been very close to a program that you might have also heard of, called Deep Blue. It was a chess program from some years back that basically got a lot of publicity but didn't make any money because it was not relevant to business. So the IBM research had been sort of smarting from this for a while and thinking, how can we come up with another grand challenge, but this time come up with something that could actually be useful in business and might actually make a buck? And so they were in a bar and they saw a Jeopardy program playing, so the Jeopardy quiz show. And one of them came up with this idea: what if we were to take some natural language processing technologies and apply newer machine learning techniques to kind of bring them together and have it answer questions and actually play Jeopardy, and see if we could train it up to actually beat the human champions in this quiz show. And this turned out to be really interesting, because it turns out that a large amount of data in the world is unstructured text. It's filtered through human brains and written down to capture what about the data is significant. And much of what is significant in the world of data has been captured by some human looking at the data and writing down what they thought was important, or writing to someone else what they were thinking about or what they were stressed out about. And so they built this machine a few years back. It played Jeopardy back in, I believe it was early 2011. And what we've ended up doing since then was taking the original tools, which were basically a huge assemblage of many text analytics, over 100 different programs for analyzing different kinds of information in written text, such as paraphrase analysis, such as who's the best actor in a film, such as, what is, let's say a pun or circumlocution in language, and applying this vast range of over 100 different analytics scorers, basically classifiers, to a given problem, to a given query. So essentially what it did was bring in a large amount of written text from humans. In this case, it started mostly with Wikipedia, and then brought in a bunch of other sources like the Internet Movie Database. And then they applied this large number of analytics and then essentially used a fairly straightforward machine learning technique, logistic regression, to apply all of these different scoring algorithms to try to vote on the best answer. Since then, we have taken many of those algorithms and broken them apart and turned them into little services as software as a service on the cloud, so that our customers can take apart their workload and apply many different classifiers, many different types of text analysis or natural language processing to their particular problem. So speaking of particular problems, we have started to apply these Watson technologies in the realms of, my area, security and risk assurance. And fraud is kind of the next big area that we see. We've already done a couple of things in the security realm. We built a Watson system for cybersecurity that was just announced a couple of months ago. We've also been building systems for compliance, like regulatory compliance. Really, the next big frontier is analyzing fraud. It's one of the most exciting areas in Watson. And as Vince just touched on, the fraud triangle of pressure, rationalization, and opportunity. When people communicate, they communicate what's important to them, obviously, and it's very common, as Vince just told you, for them to put very significant amounts of information distilled through their brain into their communications with each other, betraying things like, the pressure, the opportunity that they've got, the rationalization. So what are some of the factors? What are some of these fishiness factors that a Watson system can bring to bear? Watson systems are not going to be good at financial analysis. They don't analyze raw numbers, even trends in numbers. That's not what these natural language systems do. Rather, they understand the content and the meaning of the text, of the natural language communication between people. So you'll have things like emotional tone. I think actually Vince touched on that one. And, sorry we weren't able to see your visualization. That's a shame. Emotional tone in the sense of, let's say, for example, the Disney emotions from that recent movie, anger, disgust, sadness, joy, and fear. All of these, including some other factors such as tentativeness, confidence, analytic tone. If you have a larger amount of text written by someone, you can even get a full personality profile using the psycholinguistic Big Five personality traits, which I can never remember what they are. There's introversion, extroversion, there's open to newness, things like that. I forget the other ones. I should have taken notes on that. It's also very good at analyzing and extracting from text relationships between people individually, or between people and corporate bodies, or even just analyzing groups of people. So it can take bodies of text and create what we call a knowledge graph of entities and relationships, and you can do cohort analysis on it. You can, analyze when people seem to be, maybe a bunch of bad apples just based on individuals that seem to belong to a cohort. It can give you suggestions for when you might want to look at others that seem to be members of that cohort. Likewise, topical sentiment. Natural language processing has actually been doing this for quite a few years, even outside of Watson. The idea of looking for positive or negative language associated with a particular topic. And let's say keyword analysis as well. The ability to extract from text based on machine learning some of these factors, like what Vince was talking about, finding the keywords associated with pressure, finding the keywords associated with rationalization. If you have a training set to train the machine learning system, you can have it extract those topics and those keywords automatically for you. And let's say, last but not least, this is there's an ability to build custom classifiers. Ultimately, this is where the real power is. You can take some of the ones that I've already mentioned, like the pre-trained emotional tone detection and keyword analysis, but ultimately, where things get really interesting is when you apply the expertise of your own analysts, like what Vince would do, to teaching the system by example what specific kinds of patterns of language to look for, and then using your training examples to say, these fall into the bucket of things that I want to look for, these fall into the bucket of things that don't look so significant. And ultimately putting together a large number of these factors, aggregating them using advanced machine learning techniques to build overall ratings capabilities to assign risk. So the question came up a little earlier in the first session today of risk factors. Should we be disclosing risk factors? And in the perspective of a system like Watson, ultimately, I think the answer is that it doesn't necessarily matter if you disclose the risk factors, because if you're bringing them together through machine learning, the machine learning will automatically be mysterious. Machine learning is by nature hard to understand. In fact, it's easier to actually build an intelligent Watson system that can take into account 30 different factors or 100 different factors in evaluating a question and giving you a good, reliable answer, it's easier to do that than it is to figure out how it came to that answer. It's actually, in many ways, harder to analyze how these advanced machine learning systems make their decisions than it is to get them to make good decisions in the first place. So I wanted to just leave you with that thought. And in fact, I don't know where Leo Katz is. He had a really interesting talk earlier on social choice theory, and it made me think it would be really interesting if we could analyze how the ability of a machine, an advanced machine learning system, perhaps even a deep neural network, to make decisions based on a large number of aggregated factors. It'd be really interesting to see whether it obeyed the social choice theory. So anyway, the point of this all is simply say that the systems that you can build, aggregating large number of factors, both on the structured data side and on the unstructured natural language side, will automatically be somewhat mysterious in how it operates. And one of the more interesting challenges over time will be teaching us how to learn how these systems actually are learning and giving us answers. So I think it will automatically, in some senses, obfuscate how we do the actual logic. Just wanted to leave you with that thought. And I guess with that, I'll pass the torch along.
Okay, so Scott is going to, we gave us a little bit of an overview over some of DERA's analytic approaches in this morning's panel, and I thought it would be nice if we could focus more specifically on accounting fraud detection at the SEC and its current efforts in this space. And since we're running a little short time, one of the questions that I wanted to pose, maybe you could just roll it into this part of the discussion, is how successful have these efforts been? Have you actually found anybody using the models to date?
It's like the two questions that we frequently get are, what is the secret sauce? And then, have you caught anybody? Both are questions that are difficult to answer for multiple reasons, but let me just reiterate first that my disclaimer, these are my own views. Also, I have a couple more disclaimers to add to that. I'm not a CPA, I don't have a PhD in accounting, I'm not an attorney, yet I'm going to pretend to know a little bit about each of these areas as I walk through this. This morning I gave a little bit of an overview of risk analytics at the Commission. Now I want to talk about specifically what we're doing in the corporate issuer risk assessment space. And just a preview, I didn't say this morning, but for those of you who don't know, there are 5 divisions at the SEC. There are 3 policy divisions that focus on 3 registrant areas: investment management, trading and markets, and corporate finance. Then you have the Division of Enforcement, and then you have the Division of Economic and Risk Analysis, and that's us. And in that division, I mentioned this morning that Craig, before he left, put in place the creation of an Office of Risk Assessment. And I'll just say, when a director comes in to the SEC, generally they have, a set of pet projects or things they want to accomplish, want to do, change the world in taking those positions and before they leave. So after Craig was successful in changing the name of the division, he moved on to the accounting quality model, and he gave a little bit of an overview and some thoughts on that earlier. And what I want to do is, in this presentation, I have 2 slides. It started off with 7 slides, then it went through legal review. Now it's 2.
This is the first one.
And this is the second. So there are 4 slides. So the 2 slides are, and I think it's fine, they represent basically 2 halves to this puzzle. The first is, which is where we started. This was Craig's accounting quality model. And he gave a little bit of an overview of what he meant by that, and he didn't really intend to catch bad guys, but I don't think that's true because he did name it RoboCop when Wall Street Journal came through and talked to him. So he must have had some idea that this would...
No, that wasn't me.
Oh, that wasn't?
That was the reporter.
Okay, so the reporter, he did not...
I'm not smart enough to market that well.
But and one thing I just want to stress and as I go through this is that it actually is not RoboCop in what all these models do and how we apply it. There's a human element to it that can't be divorced from actually successfully bringing on an enforcement case. So the analytics help the human element, at least now and probably in at least the somewhat near future. I don't see AI or some of these David, what did you say, auto subpoena methods actually coming to fruition, at least within my career. But in any event, this diagram, what it shows here is a point that Craig simply tried to make easily, or a point that he thought was easy to make, and I don't know how easy it actually was to make, but this was based on looking at accounting or looking at fraud years and non-fraud years in terms of discretionary accruals. And you see here is in the top, this is the non-fraud years. If you look all the way in the right tail, there's not many large discretionary accruals, but if you look at the fraud years for companies, you see a number of outliers. And the point he was trying to make is, well, we should use what academia has been telling us for years, or pointing out and helping us to understand where there might be fraudulent behavior by looking at financial statements and creating these sorts of calculations. And he presented this actual slide to all of the division directors very early on in Mary Jo's tenure to demonstrate the power of analytics, and this actually kicked off something that we now have called the Risk Analytics Committee, where we talk about methods like this. But one of the big challenges that we faced early on is that this looks great, and on average you can find effects, but there are typically significant numbers of false positives. And when you give something like this to an investigator and you tell them, well, here's 100 firms, but only 5 of them are going to be something nefarious, and then, oh, by the way, we don't know exactly where to look. We just know there's something going on. And then they're like, okay, well, this is just too hard for me. I don't know what to do. And I think David Woodcock and his team of the Accounting Fraud Task Force, which is now the fraud group to show there's some sort of permanence to this, saw early on that there was something here, and they really invested time and effort to grow this into something that we now call the Corporate Issuer Risk Assessment Program. So the accounting quality model graduated to a program. AQM, the modeling aspects of it, the modified Jones model and the modified Craig's model are still part of that program. But this is where we have landed, and a lot of this came by working with the fraud task force and now the fraud group. And in where we ended up getting success is sitting down with investigators and just asking what they actually wanted. And they wanted things like basic information, standard financial ratios, key financial metrics. They didn't want the advanced quantitative models that showed where the risks were. They wanted basic information. And the example I gave earlier today, and I'll give again, is we had one person say, hey, I'm reading the MD&A, it's telling me there's no liquidity issues. Where's the metric that I can look at that shows me if there are any liquidity issues? Match those two things together. And so what came out of that is a dashboard, a web-based dashboard that aggregates more than 200 pieces of statistics in a way that a regulator would want to see them, so that it's no different than a tool you might get in industry that a market analyst might use for trying to pick a stock. The only difference is it's organized in a way to channel the information to an investigator to say, how am I going to find fraudulent behavior? So it's a lot of flower arranging in doing that. And then I'm just going to introduce for a second here Kwong Lee. I'm going to embarrass him because I didn't tell him I was going to do this, but he's our financial accountant. He's one of Patty's students from Berkeley, and he's been on staff for about 3 years. And he worked with Craig very, very early on. He's our PhD accountant that's developed a lot of the modeling tools, and he came to us about 2 years ago and said, hey, there are limitations to what we can do with this. Let me tell you what we need to do in order to make this successful in bringing the analytics to an investigator. And what he said is we need to develop, and I'm probably going to make some of this up and put words in your mouth, so just nod with me and say this is actually what happened, is that we need to build a tool where somebody can actually use it and help develop a case. And so we put in place a case study approach, which is how can we demonstrate how to use these analytics to get rid of the false positives and filter down to a set of firms that investigators can do a deep dive into with some guidance as to what might actually be wrong with that firm. And so, and let me just see here before I explain to you how that actually works. And so in this dashboard, some of the features that exist, it's really a tool to develop outlier behaviors, things that signal there's a potential risk. And the 5 slides that I deleted were actually graphical representations of what this might look like, but I guess I should have known that they wouldn't let me show that. But in general, peer type analysis, comparing to peers, creating custom peer groups. There's all sorts of flexibility for an investigator to draw comparisons to a body of knowledge you otherwise understand to find these outliers. On top of that, what's interesting is after we went through this development process for a year and a half working with David's former staff, and they threw out the accounting quality model, sorry, Craig, early on as not understanding it, asked for all these simple metrics, and as soon as we gave it to them, they started saying, hey, can you do some advanced modeling for us? And they went back and said, hey, where was that accounting quality model? And what it showed is that an analytic tool can't be any more sophisticated or smarter than the person using it. So by spending a year and a half building this tool with lawyers and attorneys and accountants, they learned about how to use this information, and they grew with it, and then came back and said, give me these more sophisticated modeling approaches. And so where we landed, and this is where I'm going to go back to parodying some of Kwong's work and some of his words, is pretty much a 4-step process that takes analytics and marries it to how an enforcement investigator would think about bringing a case. And it starts with the modeling. So we can develop the risk, and I won't tell you what the left-hand side variables are for what our measure of misconduct is. You might be able to guess them. I'm not going to tell you what the risk factors are, but you might be able to guess them. But this is the parsimonious inference-based model, and Kwong spent a lot of time working on this. And from this, you can filter a set of firms in any industry or category according to that risk score. And then once you have that, before you hand this over to an investigator, this is where the case study approach comes in, is you have to match it with some sort of gap violation or likely gap violation, or look for suspect accounting practices. And again, Patty did a really nice job talking about the literature, things to look for, things that have been pointed out as potentially problematic. You simply take those things, look at past AERs, look at past fraud, and you take these practices and whittle those suspect practices down, and you whittle that list down. Once you get there, once you get to the point where you have a smaller list, then you have to start looking for other things. What an investigator is going to want to know is going to say, what is the motivation for fraud? I'm going to take a case. What is it that somebody at a firm is going to do? What incentive exists for them to undertake this fraud? So what metrics can we use to glean that? And then finally, there has to be some benefit somewhere to somebody who's engaged in fraudulent behavior, right? So how do you measure the potential benefit that somebody would gain? Insider trading, they trade around it. Is it a pay package and how they rewarded these pay packages? Were they tied to a particular financial ratio and getting stock options? So you have to link all these things up, and that's how a case will ultimately be built. And how it starts, and it's actually very clever, it starts with the analytics. You add a human layer to it, and they use that analytics to get to a point where they have a subset of firms where they can really do a deep dive, and you can get a team of people working on it. So I think I exhausted all of the things that I was going to say or was allowed to say, but I'll try to answer any questions that you may have.
Great, thanks. So I think what we'll do is we're going to engage in another round. We're going to engage in another round of questions, but I think we'll dispense with that, and we'll move directly to sort of audience Q&A. So, David, you have the mic.
Yes, so this is a question for Jeb and Scott. Jeb, the way you described Watson did not sound, it sounded like you would, if you were the SEC, that you would need what Scott has described to get you to the point where you know who you want to investigate. But once you get to the point you know that you want to investigate a certain company, then you can get documents from the company, because the way you described Watson working, it needs internal documents, it needs emails and documents and text messages in order to understand the patterns and look for the relationships. But it's not a front-end tool, I'm asking. There's a big question mark behind all of this, but it's not like a front-end tool that tells you who to go look at.
It could be used for either, depending on what kind of data you had access to. So, for example, it might be possible, it might be practical to take just public data, like that which has been, put out on social media, to help give you some initial indications. But ultimately, the richer the source of data that you have, the more it can do. So you might have two different phases to it, perhaps.
Scott, you're not going to answer this question, but I'm going to ask it anyway. So let's say you have an existing investigation. Let's say it's an FCPA investigation, unrelated to, let's say accounting fraud. Any idea whether you would then, if you're not, it seems like an easy thing just to take the data you've already gathered, dump it into Watson, and see if there's anything else there. Is that a possible use for this?
Are you implying that we're using IBM Watson to do any of our work?
You're sitting aside it. I know. If you did use it.
No, so I can't answer, yes, I can't answer your question.
Hi, I have a question for Vince. How often does your firm use those tools for standard audits?
For standard audits, we are using similar visualization tools on, I'll say, on most of the bigger audits, what we call our G360 type clients, our bigger Fortune 500 type clients. Not necessarily in the context of fraud prevention and detection as to the level that I just described, but for certain audit procedures, according to our audit methodology, they're using visualization and dashboard techniques.
But not for audit detection. For fraud detection, sorry.
Well, in accordance to SAS 99, they do. So in that context, but for example, I'm not using a lot of the email analytics or any of those types of things for the audit.
Thanks.
Unless it's a proactive type, specific, targeted risk that we're going to mediate or look at.
This is for Jeb and Vincent. I've inferred from your comments that this text analysis that you do, searching for tone, that you don't use scripted comments like conference calls or investor presentations or the president's letter, that you'll use internal or private communications. Is that correct?
You want to start?
Yeah, for me, yes. It would. A lot of the, I'll say, scripted communications aren't as rich as normal pattern email, instant message, social media type communications. Could we use it? Yes, but I think the richer source is the internally generated ones, not necessarily the. I'll use the word scripted. That's probably not the right way to describe it, but internal is always better.
Yeah, I'll just agree.
Yeah.
Okay, Vince, up here, sorry. You mentioned that you'd like us to train our students in how to do this. We have, starting I think next year, AACSB requires that we teach our students data analytics at some, but you mentioned Tableau, which is great for visualization. Do you have a program that is accessible to colleges for this text analysis that you know of?
There is a lot of freeware around, that's available to do text analysis techniques like entity. I'm just going to throw out a couple geeky terms like entity extraction and text link analysis and concept analysis, topic modeling, and we just Google those types of words and you'll find the freeware. Jeb, do you think, in the Apache Hadoop environment, there's several, but they can be kind of technical and raw. What kind of freeware or technologies would be available to students, for example? Or does even IBM make certain available technologies to students?
I'm not sure I know the answer to the question, honestly. I'm a lot more familiar with our tools, but I know there are capabilities out there that have been in Apache that do a number of things. Like I think you mentioned latent Dirichlet allocation. There's other tools like cosine similarity. There are quite a few of these tools
Right.
that can do topical analyses and things like that.
My number one, if I ever see a resume that has an accounting degree and someone who's knowledgeable with Python, which is freeware, I'm hiring him on the spot. It's a unicorn. Actually, they don't exist, but if you do see them, it's pretty awesome.
I would like to echo that point. I mean, for all the educators out there, if your students learn Python, that is a major advantage for them on the job market.
You can quote that. Just I'll give you my phone number. R as well. R. It's funny in the freeware world, R for structured data, Python for unstructured, and again the two can mix and play well together. And again, that's like a unicorn with two horns. So accounting and then R and Python. Wow. In fact, I just hired one recently. They're not cheap though. They're expensive.
To what extent are you considering internal data analytics when you evaluate internal controls? So could you imagine that a firm with poor internal data analytics would have a major internal control failure, for example?
Who's that question to?
I guess that's for anyone who can answer it. A regulator maybe, but I guess, Ernst & Young.
That's probably, I see a lot of that, but Scott, you want to comment on that? Or?
I mean, if you think about left-hand side variables from an analytic point of view, anything where you can quantify material weaknesses, internal control deficiencies, restatements, AERs, so any type of analytical approach, if there's a left-hand side variable that can be measured systematically across filers, that's a really good candidate for a predictive model.
Mm-hmm. I meant more internal and data analytics. So, for example, you mentioned the capacity to look at names of accounts, right? So let's suppose that we all agree this is a great control. And now we realize that only 20% of firms have that. Would that be a major weakness for the 80% that don't have this data analytics?
I wouldn't use the word major weakness. In fact, what you'll see when the COSO guidance comes out next, it's either going to be this month at the end or early September. There's no hard date yet. But you'll see practical guidance and somewhat suggestive, not necessarily prescriptive. It's not a you must use data analytics, but you should consider the use of data analytics. And I think that's where the COSO guidance is going to be quite helpful for companies to evaluate the incorporation of data analytics, which up until now, I mean, you read SAS 99, it might mention the word data analytics once or twice, but doesn't really give very good examples. This one finally, which is why I'm so excited, from a COSO perspective, is going to really give some practical examples. Question?
This is for Vince or Jeb. To what extent are you or your clients using biometric or physiological measures for fraud detection? So it could be pulse, sweat, heart rate. I'm sure this is farther in the future, but genetic markers.
Woo! I'm not currently aware of any of our clients using any biometrics for fraud.
Well, we're all hooked up right now. Actually, just kidding.
I'm the least likely.
Yeah, at least, yeah. Now, we're not seeing biometrics, but, let me say, what's very hot right now in the world of fraud is the concept of insider threat. And again, we hear a lot about the cyber breaches that go on. And again, of course, this chief information security officer is worried about all the external threats and nation-state attacks going on. But the majority of the data leakages and issues, again, I don't want to get off topic on this group, but it's something we all should be aware of, is the insider threat within the organization. And again, not biometric, but networks and packets. And when I look at a fraud pattern, I'm not just looking at the person's travel and entertainment expenses or are they making their sales quota every month, but I'm also looking at what networks are they accessing, when are they badging in and badging out of the buildings, and what escalation and privileges have they given themselves that perhaps are out of policy. And when all those factors come in, and I talked about the risk scoring example, that's where you can really get into some big data type insight into where you have fraud risks around insider threat. So not quite biometrics. I mean, we're not checking their pulse, but I'm checking their network and I'm checking where they're clicking.
Yeah, I'll just echo that and say, as fascinating and promising as fraud is, and as huge as this is going to be, I probably have 10 conversations about this kind of insider threat analysis
Right.
with Watson for every conversation I have about fraud.
Yeah.
It's very, very hot.
Take one more question. Dan?
So after spending probably too many hours with Vince, Jeb, and you, Craig, I can share some of the frustration of dealing with this issue. So this question is for Craig, Scott, and probably Dave. Who is the SEC really going after? So we have the AERs, and we are really frustrated from the outside seeing this 0.5%, while we have a strong gut feeling and some rumors that there is much more than that 0.5% out there. From a modeling perspective, that's a killer.
What you really want is some metric that isn't just the end of the process in AER, but something before that that says, what is there something there? And the problem with enforcement is there's limited resources. You can only do so many cases, and you also have to prove in the court of law something that may be obvious with the mosaic of information, but hard to prove. And so that I'm just not answering a question, just saying it's very challenging. But I would say a lot of and where analytics really help is in corroboration of tips and complaints that come in. So the best sources of wrongdoing are usually former disgruntled employees, estranged lovers, and those who just really want to complain about something. And so that's driven not by the analytics, but by just availability of information coming in from the outside.
And I'd add, the old ACFE statistic, and it really rarely changes, is that almost 50% of fraud is detected by tip or by accident. And, less than 5% is external auditor. And, 15% management note site. It's tip and accident, which goes straight to the culture of the organization, which is probably the best fraud deterrent, in my view.
I mean, I honestly think that prior to programs like CIRA at the SEC, that tips, complaints, and referrals were the way fraud cases were brought forward. It did not come much from internal sort of sourcing. And
it's actually worse than that, because if you go back to the data, the 2006, 5, 7, we had all these accounting cases, I would bet 90% of those came from restatements. So
exactly.
Tips,
yeah. Yeah. So the one thing that since I'm no longer at the SEC, the one thing that I would like to see the SEC make more publicly available would be not just the AAERs, but I would also like to see the cases that they considered bringing forward as a fraud case but chose not to, so that you can get a better sense of what are the determinants of a real fraud case versus those that don't pan out.
That's guilt by association. I feel sorry for those poor companies, though.
Take that under advisement.
Yeah.
Jail.
Thank you all, panelists. I'd like to thank everybody. Great job.